Hello, and welcome to our discussion on the statement of cash flows. The statement of cash flows is a very important financial statement that generally follows the income statement and the balance sheet. Some would argue cash is king, and the cash flow statement is the most important statement that captures cash flows relevant to valuing a stock or understanding the solvency of a firm. This is the only financial statement that categorizes transactions of a firm during a period into specific activities, such as operating activities, investing activities, and financing activities. What's the objective of the statement of cash flows? It's rather simple. Tell me about cash. In other words, can you describe of the firm the activities that caused the changes in the cash balance? And specifically, can we get a better understanding of knowing what the cash inflows and cash outflows were from various activities? The operating section of the cash flows can be presented using a direct or indirect method, whereas the investing and financing sections simply use a direct method, i.e., when we record cash inflows from the issuance of stock under the financing section, they tell you directly how much cash was received for the issuances of those shares. We're going to focus our discussion on the indirect method because most firms utilize this for their CFO, cash flows from operations. To be clear, the indirect method only refers to CFO. CFI, cash flows from investing, and CFF, cash flows from financing, are always prepared using a direct method. Let's get some preliminaries down to set some ground rules for the preparation of the financial statements cash flows. While classifying activities are usually straightforward, issuing debt, it's part of financing, some classifications might be a little bit more challenging to understand. For example, why isn't accounts payable a part of operations, whereas short-term debt is a part of financing? Aren't accounts payable a supplier financing? The usual criteria here for liabilities in particular is whether or not we're charged interest for that financing. Because we never really have interest for accounts payable, those are going to be classified as operations. Short-term debt generally has an interest-bearing component, and we're going to classify that as financing. Why is inventory operating in PP&E investing? Don't we invest in inventory for future firm value, and don't we use PP&E for operating activities? Here, for our asset side, the criteria is generally going to be a long-term versus short-term nature of the activity. Because we expect to sell inventory within the next period, and because we expect to utilize PP&E for many future periods, we're going to separate these into operating and investing respectively because of the nature of the timing of those activities. When thinking about the indirect method, this method applies again only to the operating section of the statement of cash flows. We're going to try to reconcile net income with the cash components of net income, i.e., we're going to take out the non-cash pieces. The logic here is that net income, simplified as revenues minus expenses, contain both cash and non-cash components. Revenues might have cash and credit for any sales that you have made. In addition, net income may contain some non-operating activities, such as gains or losses on the sale of securities and PP&E. We need to remove these non-cash components and remove these non-operating components from net income to obtain the cash flows from operations. We can use some steps as a cookbook to get there. First, we're going to begin with net income. We're going to then remove obvious non-cash items such as depreciation and amortization, and any impairments of long-term assets. How do you remove these? These are expenses, and they're generally subtracted from total wealth to get to net income. So we're going to remove these and add them back. Step 3, remove any non-operating items such as gains or losses on the sale of PP&E, investments, or early repayment of debt. These don't belong in operations. These are investing and financing activities. How do you remove them? We need to add back losses and subtract gains. We're going to take care of them later on in the cash flow statement. They don't belong in operations. Finally, in step 4, we're going to remove the non-cash items in operating activities and use changes in those operating assets and liabilities to our benefit in figuring out the non-cash components. We're going to identify all operating assets and all operating liabilities, and then add or subtract the changes in those accounts as appropriate. Specifically, we're going to add any decreases in operating activities and subtract any increases in operating activities from assets. The opposite is true from liabilities. Specifically, we're going to add any increases and subtract any decreases in operating liabilities. Why do we do this? It goes back to why these operating assets and liabilities arose in the first place. Let's take an example of accounts receivable. Accounts receivable arise when a firm sells on credit. You don't get cash immediately. So when a firm has an account receivable increase, that firm sold more on credit, and it means that we have less cash. We need to take out the increase in the accounts receivable from net income, which helps us remove the non-cash component of net income and arrive at cash from operations. Let's think about the liability side. Another example is accounts payable that arises because we buy on credit rather than cash. In other words, when accounts payable increase, expenses are more on credit than they are on cash. This is going to lead to negative cash expenses. So we need to remove the non-cash component of that expense from net income, which is coming from an increase in the accounts payable. Here are steps shown in an illustration of an example. We begin our operating section using an indirect method presentation with net income. From net income, we add back non-cash expenses, such as depreciation and amortization. Step 3, add or subtract the loss or the gain on non-operating activities, for example, disposal of PP&E. Finally, we're going to adjust our working capital accounts, operating assets and operating liabilities, as we just described. From here, we're going to arrive at our net cash inflows or outflows from operations, our CFO. The direct method for investing and financing are as follows. For the investing section, we're going to include activities relating to non-operating assets. For example, if investment securities increase, it's plausible that the firm purchased new securities during the year. If investment securities decrease, it's plausible that they sold some. When we're preparing a cash flow statement, we can take a decline as an inflow of cash and an increase as an outflow. When you sell the stock, you get rid of the investment and you collect cash. When you buy a stock, you need to buy it with cash. For the financing section, these are generally going to relate to non-operating liabilities and equity. For example, if borrowings have increased, it's plausible that the firm borrowed more and received more cash into the firm. If borrowings declined, we have likely repaid it. You can make a similar argument for stockholders' equity. Here's putting it all together in a generalized example. Again, we begin with net income. We add non-cash expenses such as depreciation, amortization. We add back gains or losses from non-operating activities such as that of PP&E. Then we have adjustments for our working capital accounts in our operating assets and our operating liabilities. We then present our CFI, cash flows from investing. We may have some examples here such as purchases of investments that are going to decrease our cash and proceeds from the sale of securities which will increase our cash. Finally, we wrap up the cash flow statement by talking about activities from financing. We may have a repayment of debt, and that will decrease our total cash. We may issue some common stock, and that's going to increase our cash. If we pay out dividends, that's for sure going to decrease our cash and remove some cash from the firm. At the bottom, we will total up our total cash changes, and we're going to reconcile it from the beginning to the end. Here's a real-world example of REI, a firm that many of us already know. They begin with net income. This means they use the indirect method of preparing their cash flows. They then adjust their net income to reconcile cash provided by operating activities by adding back depreciation and amortization. As we mentioned, this is a non-cash expense, and we can see that they're adding it back. Next, they take amortization of investments and premiums and discounts, and we see that we add those back too. They don't belong here. These are investments. At the bottom, we see changes in operating assets and liabilities for accounts that we're pretty aware of at this point, accounts receivable, inventories, prepaid assets, etc. Investing activities and financing activities are prepared directly here. They tell you directly the purchases of short-term investments. When you buy investments, that's going to decrease cash and we see it decline. Proceeds from the sale of short-term investments. When you sell an investment, you get cash and we see a cash inflow from there. Going to the financing activities, proceeds from a line of credit. This is increasing our debt, and it's increasing our cash. We got $70,000 cash here. Finally, we wrap up with beginning period and ending period cash and reconcile it to our change in cash. This concludes our discussion of the statement of cash flows. Thank you for watching.